So over the weekend, the US and China had some dramatic trade talks to kind of resolve what's become this really big issue on tariffs and trade. And today they announced on both sides that there's been tremendous progress made. Markets are cheering. They're up 3 to 4%, depending on where you're looking. How do we react to this kind of market environment? What has happened in the past historically? How do we interpret this? Is this a sell the news event? Is this the kickoff of a new bull market? Today I want to unpack why this is so important, what the context is versus past bull markets, and how to remain mentally flexible in adapting to such a kind of environment. So kicking off, let's take a look at what was discussed today and how this can be very significant. So as a result of what was kind of sweeping kind of global changes to tariff policy by the United States, really it began as a global type of policy that began to then shift with a focus really on China. There started to be this back and forth between the US and China, ultimately where we ended up with triple-digit tariffs, 100% plus tariffs on China, and China implementing similar types of tariffs on the US. And this is really important because the US is a major buyer of Chinese goods. That has a huge impact on the Chinese economy, and also on the US economy as major buyers of Chinese products. That has an impact in terms of availability of products, pricing of products. So this is really a big impact on both sides, and that's why the market freaked out and we had this near 30% drop, because not only was it this dramatic change, it was really the uncertainty of how prolonged is this going to be. Is this a 2-week thing, we make a deal? Is this a 2-year thing? Does this escalate further? Does China go after Taiwan as a retaliatory type of process? So, this really, when investors get panicked, then after the mind starts to wander and prices of stocks fall, as people price in all of these suddenly potential outcomes that people never thought were possible just a short while ago. So within that context of all of that uncertainty, we've gone to what both sides have announced has been tremendous progress, which is great, much quicker than people thought, which is another big positive. And immediately we're going to go into a 90-day cool down where tariffs are going to be falling dramatically down to about the floor of where the US, I think, will be, from how things are going, will be kind of general policy, which will be at least a 10% tariff on all goods coming into the US. And China agreed to tackle the fentanyl problem a little bit greater, and also the discussion of opening up the Chinese market to U.S. companies is a big change in policy as well. So there's been a dramatic progress, much quicker than people expected, in which should really be a win-win for both sides. And that's really the best kind of negotiation, when it's a win-win on both sides. Both walk away happy, both can do better as a result, and that's just really kind of great productivity for all. So with that context, is that a sell the news event? Is that the kickoff of a new bull market? Well, if you go back in time and you look at all of the major bear markets, if you look at COVID in 2020, when obviously the pandemic was the key driving factor. If you look at 2018, when there was the bear market, that was as a result of Fed policy and the projected continual rise of rates that got markets panicked. If you go back to 2008, the financial crisis was a result of derivatives and massive debts and bad loans and the freezing up of lending. Every cycle has what is the driving force that causes that major bear market. If not, you tend to get normal corrections. Apart from a dramatic problem that manifests over a number of, at least a number of quarters, usually a number of years. If it's normal back and forth, just, markets getting a little overheated, typically you go into a correction. To go into a bear market, there tends to be a root cause driving it. Now, once that problem is resolved, that is typically what kickstarts a new bull market. So again, if you look at COVID, when all of the vaccines came out and people felt like, the worst is going to be behind us, we don't have to be locked down and all the rest, that kicked off the bull market. If you look at 2018, it was on early January when Powell changed his policy of higher rates and continually raising rates. That's when the market bottomed and went into a new uptrend. If you look at 2008, 2009, it's when the Federal Reserve and the federal government stepped in to clear off all of the bad loans off of the balance sheets, to support with quantitative easing, to keep interest rates down, to help finance these bad debts. That's when the market bottomed and finally started to go higher. Now, it doesn't always mark the exact low. So I spoke about in 2020, where there was the concept of vaccines, which people at the time were cheering. They felt like that was the solution. But the market had bottomed quite a bit earlier. Again, if you look back at 2018 and early 2019, when the Fed spoke, the market had already been quite a few days off the bottom. Similar with 2009, March of 2009 is when the market made its ultimate bottom. Most stocks had bottomed in November of the prior year, and there was a decent tradable rally. So typically off of the market bottom, the initial rally up is based on positioning. When even in a bear market, when positioning gets too one-sided, when everybody is sold, people have gone short, and everyone is in full panic mode, and so much negativity is priced in so quickly. I mean, even if things are going to be bad, it's typically not priced in all in one day. So when there's too much downside too quickly, the easiest path of the future is to actually rally stocks to get people to kind of reconsider, oh, did I sell a little bit too much? Am I too short? Am I being squeezed? It's easier to squeeze shorts and bulls that have sold out of panic than it is to keep falling lower, because so much selling is done so quickly. So again, if you look at 2018, that initial rally off the low, same 2020, the initial rallies off the low, that was because positioning got so one-sided that we start to move the other way. The new bull markets tend to actually kick off and we go beyond what is just a normal short covering rally or a squeeze off the bottom once the problem is solved. This is important because in any big leg down, any big bear market, there can be a number of those short squeezes. There could be a number of those tradable rallies. If you look at the COVID drop, there was already one big leg down. We had a big squeeze and then we had a massive drop. Same with 2018. If you look at the 2008 bear market, there were many kind of massive squeezes along the way. We need to be able to decipher, is this another short squeeze, another just moving up because of positioning, or is it the possibility of the start of something much greater, which is important. So looking at in that context, I think this is an important announcement between the US and China because it really goes to the root of what has been the cause of this bear market, which has been the trade tensions, the tariffs, and all of the rest, which is being resolved. And it's that shift ultimately, when that is resolved, that really kickstarts so many great opportunities. When you're at the bottom and you have those squeezes off the bottom, yeah, those are fast moves, they're dramatic moves, but they tend to be a poor risk reward. Volatility is very high, there's a lot of uncertainty. You're taking on a lot of risk for that initial rally. But once the problem is solved, volatility continues to drop. A lot of stocks have formed very nice bases. They start to break higher. You start to see improvement in breadth. You start to see more stocks making 52-week highs and 52-week lows. All the signs that there's repair going underneath the surface. And if you take a look at one of the tools I like to look at as well is, what's the percentage of stocks on the NASDAQ above their own 50-day moving average? In a healthy market, you should have more and more stocks each day, each week, getting above their 50-day moving average. You want to see that improvement. And if you look at past bear market cycles, once the worst was over, you start to see some pretty dramatic increases in the number of stocks that were entering basically into uptrends. So it wasn't just about the market itself, it was also the individual stocks. And so you're seeing that very same kind of improvement right now underneath the surface. So what's important is we've solved the problem, which usually tends to kind of force a lot of people who have been reluctant to do any buying, who have been mentally frozen or just scared to kind of interact with the market. They start to have a lot of remorse. That buying will come back into the market. There are people who are short, who are betting on the fact that things won't get solved. They're forced to cover their shorts. And there's a lot of institutional investors who are always invested in the market, but they start to shift from more cautious investments back into the more speculative, the more risky, the investments that are kind of geared towards economic growth versus economic contraction. If you're an investor, an institutional investor, you need to be invested in the market and you're concerned about the market. You can buy Campbell's soup and you know that people are always going to be buying food, or you can be buying something like Tesla where it's, a lot of the outcome is based on all of these, inventions that they're trying to put together. There's not a lot proven yet. And so, how you allocate your funds if you're uncertain can vary dramatically. So we've had all of these improvements, and so we should see a lot of flows go back into the market now what it looks like the problem is solved. It doesn't mean that there's no risk. There can be a lot of volatility day to day, but the market should enter into a more steady phase of accumulation if the problem is solved. But I think what's really interesting about this cycle here, and that's a little bit different from some of the other cycles we just spoke about, like 2020, 2018, is that the Federal Reserve is one of I think the only central bank that hasn't been cutting rates. If you take a look at Europe, you look at Canada, so many other central banks, they've all been cutting interest rates. The Fed's been reluctant because their view has been higher tariffs are going to cause inflation. Or at least that's been their concern. This trade deal not only takes risk off the table, not only does it open up new markets for US goods potentially, Not only does it kind of really get the risk out of the market in terms of uncertainty, this kind of removes that restraint on the Federal Reserve from wanting to cut interest rates. So they can now kind of get in there with a freer hand and say, okay, well, look, if the economy is slowed a bit, inflation is closer to 2%, we can finally go in there and kind of join our other central banks and do a bit of rate cuts. So the irony will be that, just as, the Federal Reserve was very late to hike rates when inflation kicked off, now that inflation's been coming down, they may be late to be starting to kind of cut rates and support this economy. But going beyond even the Federal Reserve, which normally the Federal Reserve is such a major driver of things, this time around, if we kind of compare this to 1998, we had a very fast, dramatic bear market. It was driven by a hedge fund that was blowing up, long-term capital management. It was so bad that the Federal Reserve had to come in and help. Once that was resolved, we really had this dramatic run back up to new highs. But what was particularly different about 1998 is that the market was in the midst of a real technological revolution. The internet was hitting, people were getting excited, they were getting euphoric about all of these new inventions and new companies, what was coming to market. Take a look at the current environment we're facing right now. AI is absolutely booming. It's starting to impact every company out there, no matter what your process is being impacted. And there's still yet so many companies that will be coming to market with new products, new services, IPOing. And so you'll have a market that's recovering. You'll have a market where people have been very negative, who have to be buying back. You have institutions that will have to rotate back into more speculative names. You may have the Federal Reserve cutting interest rates into the start of a bull market, which usually they're cutting in a bear market. At the same time, you have all of this dramatic productivity that's going on in the AI bull market. So this really sets up what I think is a potentially really big opportunity that's brewing here. That you really need to be at least mentally flexible as an outcome where we may get a lot more upside than people are anticipating. And so I know for some people, they may not have pivoted as the market started to turn. I've been doing buying for a number of weeks. As I thought the worst was behind us. We didn't know we'd get to this resolution, but I like to buy in steps. It's not an all or nothing thing. Most people kind of approach the markets as we're in a bull market or we're in a bear market. I think the best process to avoid getting caught off guard with too much exposure. If you just say it's a bull market and you're wrong, you take on a lot of risk. Or if you think, hey, it's a bear market and I'm staying in cash, there's a lot of risk of missing out on a bull market opportunity. I think the market's much more a place of where you want to move in steps. You want to put on 20% exposure, 50% exposure, 80% exposure, dial it back a little bit if there's uncertainty. You want to flow with the market rather than try to predict that there's something great coming or something terrible coming. That mental flexibility, number one, it keeps you out of trouble if you're very wrong. And two, it really provides you mental flexibility to adapt to really what are dramatic markets. There's really no certain outcome, and you have to kind of adjust as the data comes in. So having that flexibility of moving slowly with markets really gives you that opportunity. And that's what I've been doing for a couple of weeks now. But this really looks like we're entering the next phase of a bull market. So we had the initial phase off the bottom, which is the short covering and the change of dramatic positioning. I think we're entering the phase where the problem of the bear market is being solved. And this should only kind of complete itself once people go from, okay, the problem is solved, to here's a new growth, and now we're euphoric. And I think, again, the COVID bull market's a perfect example. We had the move off the bottom, then we had vaccines, then we went into the 2021 peak where people went euphoric because of gains, and then after the cycle kind of repeated all over again. So I think it's still fairly early. We're still at the very beginning. And what really helps this time was we have this massive technological revolution. So looking at big picture, I know this channel, we tend to focus on really a lot of the technical tools and how to react to the market from a kind of a professional perspective. But this time, just kind of looking at it from a big picture view, because I think what's particularly difficult this cycle is that, again, it could have easily been something that became very political for a lot of people. And that can cause people to kind of psychologically freeze up in their reactions. And you have to really keep in mind that this is a business really of just capital flows and politics. Your personal politics, you want to try and keep it out of the market as much as possible. So I've been very optimistic about the future of this market. I think we've gone from what was many negative drivers to now very many positive drivers, including improved trade conditions, a Federal Reserve that will become more accommodative, the technological revolution, and what we have is people who are very offside in terms of positioning. That should all now be helping rather than harming. So we'll see how this plays out in a number of weeks, but that's my view, and I want to kind of just give a good context of how to think of this change in stance between the US and China and how that relates to other market cycles. If you found value, you can follow me on X at Caruso Insights. You can also visit me on my website at carusoinsights.com, and we'll be back here with some new videos. Talk to you soon.